The Bank of England has shifted its flagship credit easing initiative away from households to focus entirely on supporting business lending, amid continuing concern that borrowing costs for small firms are restrictively high and a bounce in mortgage demand risks fueling a housing bubble. In a move approved by the Treasury, the Funding for Lending scheme will no longer offer discount cash for banks if they increase their lending to consumers from 2014.
The way we would characterize it is we did not see an immediate threat coming from the housing market, but we are concerned about the prospective evolution of that market in the absence of some of these changes. So the concern is where this could go. We definitely see short-term momentum, and we're starting from relatively high levels of valuation and indebtedness of households. Those are the challenges.
The scheme's participant banks will still be able to draw down cheap money based on the size of their customer lending until January 2015. But no additional lending in 2014 to households will count towards the total amount of low-rate cash they can access. Under FLS, banks can access discount rate loans from the Bank of England. The total value of cheap money banks can get hold of is tied to their lending to the real economy of consumers and smaller businesses. As the bank lends more to the real economy, the greater the amount of cheap funding they can have from the Bank of England. This is intended to incentivise more lending and so spur on economic growth as mortgages and business loans become cheaper and more freely available. Coupled with FLS, Help to Buy has stimulated demand in the housing market by making it easier for consumers to get hold of mortgages. Critics point to the UK's dearth in housing supply and say fuelling demand will artificially push up prices. However, proponents say there was much slack on the demand side, and outside of London and the South East, house prices are below their pre-2008 peak.